Okay, so let's talk about what each one of these are and kind of break it down. We're going to start with 1 and 2 because they're kind of similar, right? One's inspection of documents and records. The other is inspection of tangible assets, okay? So documents and records, we're talking about things that the auditors use for documentary evidence like invoices, purchase orders, right? Things like that. Even though it could be electronic records, we consider those as documentary evidence, okay? Tangible assets. Tangible assets could be things like inventory items, computers. At Nestle, it could be sweet tarts. It could be tennis shoes or sneakers for Nike. Actual things you can touch. So with inspection of documents, what do you think? Is inspection of documents a test that the auditor could use to as a substantive procedure? Remember the definition of substantive procedure? Is inspecting documents and records something that the auditor could use to test the details around management's assertions over the financial statements? Absolutely. If they wanted to know if a revenue transaction occurred, couldn't they go get sales orders, right? They can test. So this procedure can be used as a test of details or a substantive procedure. It can also be used as a test of controls because you can get evidence whether or not a control actually happened, right? If for some reason, or if for example, the procedure that a security guard had to do was to go around the building and ensure that all the doors were locked after 9 p.m. and then sign a log, well, you could look at that log to see if it was signed, right? So you can use inspection of documents and records as a test of controls and a substantive test, right? Now, going back to a substantive test, if it can be used as a substantive test, what assertions can the auditor get evidence for? Think about that. We're going to go to this one. It might be a little bit easier to backtrack. Inspection of tangible assets. Here, if the auditor inspects a tangible asset, I'm inspecting this computer screen here, which assertion do they have evidence for? Out of, remember the management assertions? Which ones? Existence? Yes, because I'm inspecting it, I can physically see that it exists. It's here, right? Valuation, not so much. A little bit, but not so much, because looking at an item, I cannot tell if it's properly valued per se, right? But I can get some evidence as to whether or not, like for instance, if I went to go on the warehouse floor and I saw some forklifts in the corner that were all rusted with cobwebs on it, with holes in it that obviously haven't been used for years, I could probably say, let me go back to their books and see if that has been fully depreciated, or do they have it as the wrong valuation on the books? So slightly, but mainly inspection of tangible assets would give you evidence for existence of an item. I see it, it's there. But if for some reason you're talking about inspecting a bank statement, that would be inspection of documents and records, yeah, or record, electronic record. So yeah, if you're inspecting we'll come back to the bank statement because that's a good example. When you're inspecting a bank statement, yeah, that's an example of inspection of documents and records. Very good. So in auditing, we have, or at least we used to, we used to have what's called floor to sheet and sheet to floor testing. Anybody ever heard of that? Floor to sheet, sheet to floor? Floor to sheet, sheet to floor testing. In this example, I'm going over, the sheet is going to be some sort of documentary record. In this example, we'll talk about inventory. So it's going to be a list of inventory that you download or you get from the client's system. So it's included in the client's records, right? It's a proxy for the inventory balance on the balance sheet. So the sheet comes from the client's system. And we're specifically talking about inventory in this example listing. Also in this example, the floor stands for a physical location, like the warehouse floor or the office floor, if you will, right? So the sheet is a proxy for the client's financial statements. Here, it's going to be the inventory account, and the floor, the physical location. So if I looked at the client's inventory listing in their system, printed it out, so because I like to physically look at stuff, but you guys are tech inclined, so you probably would just look at it on the screen. And I picked out a sample of items for Rutgers, per se. And I'm like, Rutgers says that there are 50 chairs located in room 528, right? I go from their inventory listing and I picked out a sample of chairs. And then I went to the floor to locate those chairs. Which management assertion would I be getting evidence for if I did that audit test? It's existence, right? Because I'm physically seeing if those chairs are real, that the client has 50 chairs listed on their books in inventory for this location. Are they actually there? Are they real? So when you do sheet to floor testing, the auditor is doing a test for which assertion? Existence. Now, let's say that I'm already in this room and I'm looking around and I'm like, there is a clock in this room. I wonder if Rutgers has that listed in their inventory. So I'm on the floor, physically in the location, I see an item, and then I go back to see if it's included in the client's record. Here, I'm going from the floor to the sheet. If I did this test, seeing if that clock is included in Rutgers records, what assertion would I be getting evidence for? Which one had to do with whether or not, the key question was everything recorded that should be recorded? Is everything included that should be included? It's completeness, specifically completeness of Rutgers inventory records, right? So if I did this test, I would be doing a test of completeness, right? Because I'm seeing if everything that should be included, because I see this physical clock, it should be recorded. Now I'm checking to make sure that Rutgers recorded everything they were supposed to record. So it would be a test of complete. Now, to bring back to what Anthony was saying about tracing and vouching, one of these tests is an example of tracing, and the other one's an example of vouching. So what is vouching? So vouching is literally, as Brendan said, is going from the client's records or their system and locating evidence for that or source documents. Which one of these examples would be an example of vouching? Vouching said that you started with where? Where do you start when you vouch? The journal or ledger, right? That's going to come from the client's system. It would be this one. So with vouching, now where do we start when we vouch? The financial records. I say the client's system. I also say, because later, remember I told you in this class that there were going to be layers to this. When we start talking about tracing and vouching later, we're going to learn that you can trace and vouch from different types of documentation. But in general, you're going to go to something general to something specific because you want a specific knowledge, source, or proof. So you start here. And then where do you go to? Where do you compare that item from or to? Somebody mentioned it before. Where do you end with vouching? Source document. That's where you're going to get proof. If I want to know if a revenue transaction happened or a sale actually happened, I get the sales journal from the client system, and then I go find evidence or a source document that gives me evidence that that transaction actually happened. So that could be a sales order, be a shipping document, it could be sales invoice, right? Something that gives the auditor evidence for that transaction. So if you're just trying to find evidence for that a sale happened, you can vouch to all three of those documents I said. It doesn't mean you just only vouch to one. You can vouch to multiple, and you can even vouch from there to something even more specific. But the idea of vouching is that you start with the client's system or their financial records or proxy for it. Somebody mentioned journals. We talked about listings, trial balances, things that come from the client's accounting system. And then you go find proof of that. So this is going to be more specific. So if I start with the client's records, the financial statements, and I look at them and I say, well, they say they have $1 million in cash. And then I go find evidence that they have $1 million in cash. Which assertion am I getting evidence for? Existence of cash. What's the assertion that you vouch for? Existence. But what if, like the example that Tanya and I were talking about, I look at the client's income statement, I see that they say they have $1 million in sales, right? I go back to the sales order, the shipping document, the sales invoice, and get proof that that sale actually happened. What assertion am I getting evidence for? We're starting with the client's records and seeing, do we have proof that something actually happened? Now remember in this example, it was income statement, sales, going to the sales order and the shipping document to find proof that a sale actually happened. It's occurrence. Remember when we first went over those assertions and I said, remember that some of them have to do with balance sheet items and some of them have to do with income statement items. Revenue, sales, expenses are on the income statement. So if we are vouching revenue, sales, we don't vouch for existence, we vouch for occurrence. Remember I kept saying, did it actually happen? Because that was the key question from when we went over the assertions. So when you're vouching, you're going to be vouching for either occurrence or existence. How do you know which one it is? Well, if you're starting with a client's records, that's a transaction or event, aka the income statement, you're going to be vouching for occurrence. If you start with a balance sheet item, cash, liabilities, accounts receivable, and then you go to a source document, you're vouching for the existence of that item. When vouching, you start with the client's system, their financial records, some sort of proxy for that, and then you go to something more specific, a source document for evidence that either the transaction happened or the balance actually exists.